Hi, I'm Steve LaFrance and welcome to our quarterly market update, a recap of the first quarter and what we're watching as we head into Q2. Bottom line, the first quarter was a period of rotation and recalibration. While uncertainty remains elevated heading into Q2, diversification is working. Fundamentals are holding up and patience continues to be rewarded over time. The first quarter looked worse on the headline than it felt in many portfolios. The S&P finished the quarter down roughly 4%, yet beneath the surface, the average stock held up far better. That split captures the story of Q1, a rotation in leadership, a short but sharp energy shock, and a market that's rethinking how soon rate cuts might arrive. First, leadership rotated. After years where a handful of mega-cap tech names dominated returns, Q1 saw smaller companies and value stocks outperform. That broadening matters because it means gains were more dispersed even as the headline index slipped. A reminder that headline performance can hide important internal market dynamics. At the same time, business investment was a bright spot. 3-month moving average business investment rose 7.7% SAAR, led by technology and AI-related capital spending, which is supporting growth in parts of the corporate sector. Second, geopolitics and energy moved markets. The closure of the Strait of Hormuz pushed oil prices sharply higher, and higher energy costs feed directly into inflation. On the inflation front, the components tell a mixed story. Energy was up roughly 20%, while services, excluding shelter, rose about 3.3%, and core goods were down about 4.1%. That mix, a big energy spike alongside softer durable good prices, is one reason investors pushed out expectations for a Fed rate cut and began to price in the possibility that rates stay higher for longer. Third, the economic fundamentals remain intact. Under the surface, growth is still running at a healthy clip. GDP growth is tracking near a 2.7% annualized pace, and aggregate wages accelerated modestly, with wages growing at nearly 4% annualized rate and unemployment slightly above 4%. Those pieces matter. Stronger wages and solid business investment help sustain consumer demand and corporate earnings even as a headline volatility rises. So what does this mean for your portfolio? If your goals, time horizon, and risk tolerance haven't changed, the sensible course is to stay invested, maintain your target allocation, and keep doing what you've been doing. Diversification worked this quarter. Portfolios spread across size, style, sector, and geographies generally experience less volatility than the headline index. Markets will always surprise us, but process and discipline are what deliver long-term results. Thanks for listening and for your trust and confidence.